future. From short selling to big bonuses are under threat. But even one former trader thinks change is overdue.
I do think that the city is dominated by bonus culture, and I do think the bonus culture is to blame for the credit crunch and the problems we currently have. I also think it's going to take several years at least before that changes, because you don't go into the city for the love of the job or for the creative potential. You go there to make money.
And it's very big money. The top 5 US investment banks paid a record £36 billion in bonuses to their staff in 2007. That's an average of £191,000 per person. But what, if anything, are the regulators going to do about it? The Financial Services Authority's new chairman is making it clear he doesn't think big bonuses are the main cause of the banking crisis. But he told our business editor that banks which do encourage excessive risk could pay a price.
If we think that what they're doing is risky, if we think that they are in danger of encouraging people through that bonus structure to take risky actions which appear to look good at the time, but which create toxic assets for the future, then we have the power to say, well, if you want to do that, you've got to hold a bit more capital.
Greed is good. That's long been the mantra of investment bankers who claim that big bonuses not only motivate them, they've helped turn Britain into a global leader in finance. So what happens if a whole lot of this money is suddenly taken off the table? London is now second only to New York as a financial centre, but global banks who find life too uncomfortable here could up sticks and head, say, to Frankfurt. But some city observers think a little pressure might work.
Provided you do it carefully and thoughtfully, you probably can put in some restrictions that will have relatively little detrimental effect, and one or two might even have a positive effect.
But bonuses aren't yet out of fashion. After buying Lehman Brothers' New York operation, Barclays has told staff there they will get a couple of $1 billion already promised to them. Rory Catlin-Jones, BBC News.
I'm Jonathan Davis, Chartered Financial Planner and Managing Director of Armstrong Davis Financial Advisors in the City.
And you're here to talk about house prices. Let's see your film.
I've been forecasting for the past 2 or 3 years that house prices were going to crash. Not correct a little, but crash.
Even before the events of last week, the housing crash had already started. Prices are down 10% since last year. Repossessions are rising, sellers can't sell, buyers are few and far between, and the banks and building societies have severely restricted their lending. So how does the global financial crisis affect an already depressed housing market?
According to the Council of Mortgage Lenders, repossessions have already increased by 48% on the same time last year. Last week's news is going to make things even worse, and increasing unemployment will only put more downward pressure on house prices. In theory, this is good news for first-time buyers like Katie, but many still can't afford to enter the market. So what have we seen? Sellers who can't sell despite slashing their prices, buyers who won't buy in the current economic climate, and the collapse of global financial institutions, which could lead to rising unemployment and repossessions. Add those factors together, and I believe that house prices are not going to recover anytime soon.
Previously, I was forecasting a fall of 35% in house prices from peak to bottom. Given the events of last week, I'm now wondering if that was a tad optimistic. I put it now at a probability of 50% that prices could fall by a half.
Even before the events of last week, job losses were rising at an alarming rate. In the 3 months up to July, 138,000 people have been made redundant. That's up almost 30,000 on the previous quarter. With our jobless total hitting 1.72 million and rising fast, the word on everyone's lips is recession. The last time the country faced one of those, former Conservative MP Michael Portillo was in the cabinet.
I mean, it's tough to say this, but, you know, resourceful people who've got get up and go in initiative, they'll probably find a way through. They'll probably find a way of keeping their work or getting different work, and maybe it will turn out to be a great thing for them. The important thing is that people get out of the jobs that are going and into the jobs of the future as soon as they possibly can. I wouldn't want to be building houses. I wouldn't want to be supplying anything that goes into houses, because I don't think people are going to be moving very much. I wouldn't want to be in the travel business or the airline business. I definitely wouldn't want to be in financial services. That'll do for starters.
What do you think the actual unemployment figure will hit?
My guess would be the actual unemployment figure will be between 2 and 3 million. If you push me very hard, 2.5.
Last week, we saw the government step in to fast-track the merger of HBOS and Lloyds TSB. Jobs will still be lost, but maybe less so than if HBOS had folded. That decision gives me hope that the powers that be are taking this crisis seriously. The government intervened to restore confidence in the city, and I believe they'll do whatever it takes to keep unemployment below 2.5 million. With Gordon Brown's back against the wall, the only way he stands a chance of keeping his job is if we keep ours.
Banks do want the customers who have cash, though, but many consumers are scared of putting their money into savings for risk of losing them if the bank goes belly up. Now, more than ever, the safest place for your money is in the bank. I believe there's absolutely no way the government would allow a retail bank to fail. But it's not as if that means all investors are safe. The real losers are those of us who rely on the stock market for our pension plans. As share prices fall, the situation becomes more and more dire for our pensions because so many are heavily invested in the stock market.
I think you can say that for people's pensions, it's quite a dire situation. And you've seen that with 1 million people pulling their money out of personal pensions over the last year, and a decline of probably around 20% in the value of pensions.
The recent decline in the stock market means that people who are planning to retire soon might find things aren't quite as comfortable as they'd previously hoped.
I'm 61 next month, so I could have retired from the police at 55, but I've worked on, try and build up my pension a bit more.
Robert Michael has been planning his retirement in Cyprus for 5 years.
I'm very concerned about what I've been hearing over the last few weeks, and I'm very concerned that my dream of going to Cyprus within a year and retiring, finally, may still not, I might still not get there.
Actually, thanks to his careful planning and spreading the risk, things probably aren't that bad for Robert, and his retirement dream will still happen. And I believe long-term the market will bounce back, but many retiring in the near future would have reason to be very worried. There is no doubt that what we are witnessing is a huge banking crisis, the worst we have seen for decades. Recession is now inevitable, and that's merely confirmed by what we saw last week. Despite Friday's stock market bounce, I don't think this is over yet.
Can I just ask you the moral question, okay? What really disgusts a lot of people, and a lot of people think is immoral, is that incompetent, greedy bankers have been shielded from the consequences of their incompetence, right?
Yeah.
And we're all suffering from it. So how can we punish them, if you like, for their misdeeds if they do it again in the future?
This is the problem. I think we do need tighter regulation.
How do you do it, though? I mean, do you say you can't make more than 10 million a year, or do you ban certain sorts of financial dealings? What?
The problem is, if you start putting, limits on how much salary you can have, I'm afraid to say that places like Zurich or Paris or Frankfurt or even Dubai might take over London as a financial centre. And although we may hate many of the city boys for their excessive lifestyles and their vast salaries, they do bring in quite a lot of cash. I was going
to say, I mean, whenever something like this happens, everyone wants to shoot the bankers. And there are some nasty, greedy bankers, but there's also some people who just try to do a reasonable job.
You say in your film that most people's savings are safe. Do you really think there is now absolutely no chance at all that any high street names will go bankrupt?
I really do believe that, with 99.3% certainty, that the government would not allow a high street bank to go bust. What we've seen has allowed to go bust was Lehman's, which was the fourth largest US investment bank. It's a different kettle of fish when you've got people's savings are the issue. And there will be a bailout of some kind were there to be a problem.
So it doesn't matter where you have your money in the UK, you're fine?
Essentially, the large UK banks are safe.